Okay, good morning and welcome to the Minervini Private Access Trading Room. I'm Bob Weissman. If we could do first a sound check by raising your hand to let me know you're hearing me okay. Hope everybody had a nice weekend. If you're up north, sorry to hear about the winter blast you're getting, but I'm in South Florida, so I don't have to deal with that anymore. Mark, welcome into the room as well. Hope you had a good weekend.
Yeah, happy Monday from snowy Chicago, everybody.
All right, raise your hand if you could. Just let us know you're hearing Mark as well clearly. Excellent. And we really want to get through as many of the Q&A questions that we've been backlogged on the last couple of weeks. So, Mark, we're going to jump right into it and get started if you're ready.
Absolutely, let's do it.
All right. So Jim is asking, when shorting the indexes, do you ever use the leveraged ETFs, the doubles, the triples, the ultras, or are there unusual implications to holding these longer term because of the leverage versus a standard short such as DOG?
I don't use the leveraged ETFs very much, almost never. But listen, I would say if you wanna play the Dow and use a 2 or a 3x, that's fine. But I would just correspond the stop to the same area. What you want to avoid is, when and keep in mind, the shorting is something that you do when either Mark thinks the market looks vulnerable. Sometimes I take them, sometimes I don't. I look at how things are going, and then I do them as a standalone trade. But what I wouldn't do is to use a different stop or something like that. So if you want to use a 2x, that's fine. Just you have to understand the risk and then use the same stop Mark would use on the Dow. So stop out your short when the Dow is stopped out, because that's where, yeah, sometimes you get the moves are a little bit different, where based upon the recommendation, you just want to stick with the actual stop.
And that's important to recognize that you usually can use the doubles, but use half the number of shares to have the same type of position. Let me also highlight one of the questions that did come up occasionally with Mark's stop on the DIA. We have the DIA short, of course, as Jim just mentioned. If you can't short in a retirement account, a tax advantage account, you can use the DOG, which is the actual inverse. But with the DIA, Mark has a stop right above the high here, that being the 312.80. But also he shared with the index itself on the cash index, you want to make sure that the cash index also is taking out the 31,273 level. So just because the DIA may go above that stop, Mark is looking for the confirmation of both triggering. And only one or the other triggers. That does not mean Mark is out. Both have to trigger for that to happen. Here's the question of the day or week for that matter. Also, as a follow-up, Jim's asking, does the amount of short interest ever come into play in your decision to screen for individual names with GameStop and all the AMC theaters, all the rage of Reading
Yeah,
and the shorts? What
yeah,
is
this has
your
been
comment to that?
well. Yeah, I won't get in. We could talk about some of the other stuff if we have time, but the short answer is no. I don't screen based on short interest. The way I look at short interest from time, I will look at it, but specifically if a stock that I'm holding, and normally I would consider something that's higher short interest, might I look at the days to cover on MarketSmith because that kind of tells me, um, how much potential buying power is there if a stock hits new high ground. Because guys, we're looking to trade the strength in the market. So most of our setups are names that are hopefully within days or very close to moving into new high ground, and that's sometimes where you see those shorts cover. And then the other time I look at it is prior to earnings. So if I'm going to hold a name into earnings, I actually like to see a little higher short interest, because if there's a beat or a good announcement, there's a little more fuel that those buyers or those shorts have to then buy in their positions. But these really heavily shorted stocks generally are the names that are we don't see, because they're trading, and we're talking where 20% of the float is short or something like that. We're talking about names that a lot of people are heavily short because they think the companies are going bankrupt. And then you can see these squeezes. Obviously, there's been a whole host of other things, contributing to this. But I don't have anything in the actual screening criteria. And that's a question we can ask Mark too, but I'm pretty sure he doesn't as well, as far as, screening specifically for percentage of a float that's short.
His number has always been only if it gets really above 20% or 20 days outstanding is really the number of Mark more focuses on, because what that is insinuating is how many days based on the average volume would the stock need to be able to cover all those shorts. And so what he's looking for is uh, more of a representation of that could be driving. Of course, these are short squeezes of a generation, and there's been, like Mark said, a number of these over the years. But this is certainly the play of the day these days. But unfortunately, none of these are meeting our criteria. None of these can we be buying. If we could, we will be watching them for sure.
Bob, I'm
But
here.
oh, okay, Mark. So let's just have Mark have
Yeah,
you explain a little bit during the weekly study session as well.
yeah, real quick. I just hold on one second here. Let me just bring this up. Okay. Yeah, as far as short interest is concerned, it's sort of like, it would be great if we had a big short interest in a stock that was set up and we were buying. It's not a criteria, but it would be nice to see, and then and the stock breaks out and you can get that short covering. I think we're seeing a theme right now where I always talk about how there's themes in the market. I think this short covering stampede, however it's playing out, and there's controversy over Reddit and Robinhood and all these various things that are going on in the news. But the bottom line is there is this stampede where we're running stocks up, and that sort of seems to be a theme right now. But yeah, and like Bob was saying, if you see 15, 20 days worth of volume short, that's a healthy amount of volume. That's a healthy amount of short interest. So you can, that's how I calculate it, by the number of days of average volume.
Yeah, and I know the conversation when seeing these names. Just as a quick comment, the when you look at Bitcoin as being the safe and non-volatile trade, that's pretty funny. But these names are moving. These names are
Yeah,
moving
kidding.
50 to 100% a day. It's just incredible volatility. Let's move on though. So Mike is asking in Mark's video, he starts off with the S&P versus the trend following model. Can you explain why the trend following model, what the trend following model is? I don't understand it. From May going forward, it is a horizontal line at 100. What does that mean?
It means all the indicators are bullish, and when it goes below 50, it's a sell. When it's above 50, it's a buy. At 50 would be neutral, of course, but that would be
Very rare.
yeah, it's basically a buy sell indicator. Above 50, you're buying and you're selling below. It's not something that I trade off of. It's just it gives you a good indication, though, what the longer term trend, the wind is, whether the wind is in your sails or against you. I can make that determination usually before that model flips over, and the risk model is definitely going to be much more intermediate and give you turns very close to the highs and the lows more than the long term. But if you're, it's a great model if you're trading your the S&P and so your 401ks. We had interest in that, of people trading their 401ks, so that's why we brought that model.
And also, just to be clear, because I get a lot of questions from people when Mark does post a risk model moving to a sell alert or a sell signal, that is only the risk model. It is not reflecting the long-term trend. If it was, we would post that the long-term trend is changing. But as Mark
That's
shows it every week in and week out, those readings all at 100% means we're nowhere having any deterioration in the long-term trend. So that's what's reflected with Mark's review every
But
week.
but something that's really important to understand is that a long-term trend model like that, the nature of it is that you may have to come off 20% off the highs before you get a long-term sell signal. You may get one that's 5 or 8 or 10% off the highs, but it depends. So if there's a lot of momentum to the upside, it may take a big move to the downside. So this isn't like, a pinpoint timing indicator. This is just to give you confirmation, whether you're in a long-term uptrend or downtrend. You should be long gone, within your stocks. So again, forget about models. Get good at following the stocks and trading the stocks, and that's really, as much as I report these models and economic indicators and whatever we look at, 95% of my decisions are being made by the individual stocks. Mark, Richie, I mean, how about you, right? I mean, what percentage of your decisions are being made outside of, how stocks are acting?
Right. No, none. I mean, yeah, like you were saying too. I mean, these long-term models won't turn for. And I don't even. I'm glad you were here to answer that question because I wouldn't have known how to answer it in terms of it's going to be a while before that.
Yeah.
Think of it. That's like the aircraft carrier. It takes a little bit to turn that baby.
Yes.
Yeah.
Yeah.
And the design is obviously to keep you in the market from the wiggles and the waggles of little 5 or 10% corrections. Long term, the market should outperform that. But
Right. There's a price to be paid. If you want to stay in the market for 2 years and not get a sell signal, well, then it's going to have to give a lot of room, a lot of wiggle room. There's no free lunch. Either you're going to buy and sell signals more often and you're going to trade in and out, and you're not going to stick with a long-term trend. You're going to stick with a long-term trend. And you're going to have to give it a lot of room.
Jason's asking, with the rationale of having CMG on buy alert, it looks to me like it's extended and a short base now sitting on top of the previous base. It did not pull back so much, so not qualifying as a cap pattern. Here,
Oh,
CMG is up.
it's not a cap pattern. And I'd like to know, maybe Mark Ritchie, what you think about this also. 76 relative strength is definitely low. But it did break out recently. And this is just a stock that broke out and is holding up really well as the market's pulling back and going really tight. And if you see the relative strength line, 1, 2, 3, 4, 5, when I see 6 weeks of outperformance, 6 weeks minimum of outperformance on the right side, especially if it's in a market pullback, that gets my attention. And so that's some short-term relative strength. I think they have earnings tomorrow, right? So that kind of blows the trade.
Yeah, that's also something to always be mindful of, guys. In the middle of earnings season, they does have earnings tomorrow after the close, so you're always got to be making sure you're checking to make sure that there's not something that you could get blindsided by.
But this stock is holding up tremendously well, and based on the chart, it looks like you might get a happy surprise on the earnings. But anything can happen. That's with earnings. You just don't know what's going to happen. It could look good one day and it gets blasted on earnings. So, but right now, if this didn't have earnings coming out, I might be buying this.
Also, he's asking, in the weekly review, you mentioned that you'll probably be waiting till midweek before you take any action. Does that mean we hold off buying any names that look like they're breaking out, like STTK did earlier today and Lake today, LAKE?
Well, again, Mark, I want you to talk about this, and really, it's to your own risk tolerance. I mean, if you want to wait a little bit, and it depends if you've done well and you've got backlog profits, whether you're, very new at this. There's not a blanket answer. I mean, yes, if you want to do some trade, you could take some trades. I would trade smaller, than normal here. I would be careful. If I was new at this, I might just wait and watch a little bit. Mark, how are you handling? We're in a little bit of a pullback here so far. What are you
Yeah,
doing?
no, I mean, you nailed it. I think the biggest thing is how's your trading been going? But for me, I'm actually probably the most cautious, but this is in terms of smallest positions or exposure, and probably probably in 9 months, or since the lows in April.
Yeah.
Just because the action's been a little wonky, and I don't know, something smells to me right now. Just after doing this long enough, and when you're coming off a really good run, and you get just froth all over the place, 2 to 3 days pullback doesn't seem like enough to me. And there's just not a lot of ideas, even that if Chipotle is the best idea we got, I'd rather just wait. You know what I mean?
Exactly. If Chipotle is the best idea we got. I mean, there's some things moving here. It's your short-term trade. Look at AVNW. I mean, this is one that, I was thinking about, buying this
It's
morning.
blasting off here, yeah.
It's blasting off. And I pointed this out in the video. This is a little pullback buy, and it built that right side. I mean, look at this, 20%. So, but again, I would be maybe blown out of this here, maybe definitely sell some of it. So yeah, that's
Yeah, Mark highlighted that this week's study sessions. So make sure you are watching those study sessions, even if you didn't watch it before this event. Make sure you do watch that later on. Jim, another James rather question is asking, how do you set the limit price when you're about to purchase the stock? Do you use the ask price at the time, or do you set a price somewhere between the bid and the ask, or do you set the limit at 2% above the pivot itself
well, you don't mean
for using a buy stop limit order?
Well, you would just set it. You're doing is a buy stop limit. It's gonna trigger at the price that it trades. So you can't set it at the offer. It's gonna or the bid. You can you won't know what the bid or offer is at that particular moment. So you're just setting it at, if you're setting a limit price, it's going to trigger when it trades at that price.
But you're going to want to use that pivot price point for measuring your 2% amount of chasing, if you will,
Yeah,
above the
you're
pivot.
using the chart to determine whether it's extended. So if the pivot is at 20 and you don't want to be more than, 1 or 2% above that, then of course, you'd be at 20, 20, 20, 20, 40.
Okay, Eros is asking, did you ever have a position that gapped down 30% or more on you, and how did you handle it?
A couple of times I had some pretty big. I'm sure if I ever had one gap down 30%. Future Healthcare was a stock in the early 90s that I was going to buy, and I didn't. The next morning, it dropped 90%. It gapped down 90%. That was my closest near miss, if you will. But I don't really recall having a stock gap down 30%. No, I've had a few gap down 10 or 15.
And when it does gap down, how you handle that?
I usually sell
Sell.
immediately. Yeah, sell.
That's what I was waiting for.
Or it becomes a 30%.
Yeah.
I mean, if it gaps down and within seconds it recovers, like sometimes it'll gap and literally
That's the low.
before you can even press sell, it moves up, 10 or 20 or 30 cents. Sometimes what I'll do is I'll say, okay, I'll just stop at the low. If that happens, but usually I'm just, I'm getting out. I mean, it hits my stop, I'm out.
Do you know, Mark is asking, what percentage of names do you use a pullback buy entry as an entry versus a breakout?
I don't know, a lot less pullback buys, but it depends on the theme of the market. If there's a lot of pullback buys setting up, then I'd be using pullback buys. If there's a lot of power plays, then I'm trading power plays. If there's a lot of low cheats, I'm trading low cheats. Each market environment kind of throws you a theme, and you try to latch onto that theme and find out what it is and then exploit it, of course. So yeah, it really depends on if you're getting really great setups with pullback buys. But to answer your question as far as what the percentage is, Bob, you would know, you track the numbers. Yeah, it's probably pretty low, right?
Yeah, it's we probably do breakout 80 to 90% of the time. Pullback
Yeah.
buys is probably 10% or maybe a little more.
Yeah.
Especially where Mark is speaking about is when you have those corrections and then you have a lot of the back and filling on the right hand side as opposed to the V shape that we had last year. If you had a lot of the back and filling, that's where you would get a lot more of those pullback buy setups that would be opportunities, whereas the V shaped recovery just led to blast off after blast off last year. Balaji is asking, I understand GME is too volatile for Mark's criteria, but if you decide to trade in GME, how would you have managed the trade or the risk? Could you want to comment anything about that, Mark?
If I was your accountant.
You're not my accountant.
Which is not my accountant, but if I was. I don't know. I don't like talking in hypotheticals. I mean, I would handle it no different than any other trade. You certainly, it broke out. I mean, it came out of a little sideways base on 113. I have some friends that were buying this stock when it was breaking out. I had a few of my friends call me up and ask me about GME when it was breaking out. I said, it looks pretty good. It was breaking out of that little consolidation right there. They hit pay dirt, and the next thing the stock is up, is up 100%. And then from there, several more 100%. I would have sold it much, much lower. It's up at 400. I probably would have sold it at 50. So
you guys see how Mark trades hundreds and hundreds of times in the last year alone. So he's going to be peeling off profits along the way up.
Well, and you can look at one thing I was going to say, Mark. I know Matt Glasscoff does this in a situation like this. He'll look at the intraday and trade these little VCPs. That's one thing you can. But it's the same patterns. He'll just do it. More for day trades. I mean, that's something you can do as well. But once this thing gets extended, I mean, you don't want to be holding it. And I mean, not if you're trying to manage risk tight.
Yeah, if you want to play for a bigger move, draw a line in the sand. The stock's up, you're up 30% on the stock. Okay, what do you want to protect? 20? All right, so draw a line in the sand. Stop out at if it comes back down where you're only up 20%. Stock goes up, now it's up 50%. Draw another line in the sand. Draw it at 40. And just keep following it up, but give it some room and just come up with a number that you want to protect, that you're happy with. If the trade turns around. Now, again, how many times you end up with a situation like this?
Yeah.
Mark, in all the time you've been trading, how many stocks do this?
This is great. I mean, yeah, I don't know, one out of every 200,000 or so. It's probably
Right.
even less than that.
This really isn't where you make your money, believe it or not.
No, it's not repeatable. That's what the point you're making.
Right.
What we're trying to do here is repeatable.
Exactly. These are aberrational, moves, and these are things that it's great if it happens and you happen to be in it, but this isn't something you can count on.
I mean, I know you make the point, Mark, too, but I just feel like the stock is a good point to make now because the percentage. I got so many texts and calls last week about that stupid stock, and when you get people that have no idea what they're doing, telling professionals, why they should or shouldn't be buying something.
My 12-year-old nephew called me.
Right.
I swear to you, my
I
12-year-old,
believe it.
he called me, and because of GME, he wants to open a Robinhood account and he wants to trade.
Well, you can for one share at a time.
Huh? That's what he said.
Share at a time.
Well,
Open
just
a Robinhood
it's a
account.
fascinating. Yeah, just how viral it went. It's just crazy.
ALTM was listed on buy alerts a couple of weeks ago. Is it still buyable? And what are your thoughts on a buy point, or why is it not a good buy at this point?
Which one is that?
ALTM up here on the chart.
ALTM. Yeah, I think that was coming out of a power play type setup, right?
Oh, yeah.
Yeah. Well, now it's gotten a bit, a bit squirrely here, and it's gapping up today. So now you've got, I'm not going to chase a gap like this. Mark, you're good at recognizing and taking advantage of failure resets.
Yeah, no, this one's too wide. There's no pivot, and I certainly, like you were saying, yeah, it just needs to tighten up. And in this environment, though, I wouldn't be playing the failure reset right now.
Right.
I think, Mark, you would probably agree with that because we've had a lot of pivots that have kind of failed, and the market's looking a little wobbly. It just, to me, it doesn't seem like a high probability situation.
Yeah, I agree. I would look for, larger bases that formed, and then now with the market coming in, they're outperforming in the right side and tightening up. And you see those relative strength lines are, moving up because of that. This AVNW was a perfect example of one that, is building that right side while the market's coming in here. And it was, moving sideways for a while there. We had it on buy alert, I think, a week or so ago too. And building that right side. CMG is a perfect example, but like I said, they have earnings coming out. You got a few of these names. And what else is on here? So we got, this IDT. There's one with a little tight little pivot there forming on the right side. There's a few handfuls.
When you look at those names versus this name, and I just drew in here, you can just see the volatility. It's getting wider and wider. It's not what we want. We don't see it tightening. That's the whole key. Moving on, Robert's asking, Mark, you mentioned in the January 25th study session last week, you generally avoid bank stocks. Are there any other industries you generally avoid? What about stocks heavily influenced by commodity?
That's for me, right?
Yes, commodities like gold or oil.
Well, those are the kind of more special situation. Those aren't growth stocks. Well, I'll answer your question. I generally avoid paper, steel, deep cyclicals, the commodity type names, oils. But of course, I have DKL. That's the oil started performing. I decided to try a name there, but you'll see that that's not the norm for me. If you go back and you look at the biggest winning stocks going back 70, 80 years, the biggest winning stocks came from 70 to 80% of those big winning stocks came from 5 or 6 groups. They were biotech, medical, drugs, computer, peripherals, software, computer related technology, retail, and leisure entertainment. And then down the list is financials and telecom. Those are the groups that made up about 70 to 80% of all the biggest winning stocks going back almost 100 years. So that would be my main focus, would be in those areas.
Gary's asking, looking at ATCO up here on the chart, can't figure out why this would not be on buy alert. I think it looks great for an early turn.
Which one is it? AT?
ATCO.
ATCO. Yeah. Well,
So
first of
besides
all,
the 69.
you need besides the 69 relative strength and it's an $11 stock. Yeah, it looks good. It does. But you have to put things in context. And right now, with the market looking like it's going to correct here, I'm not sure I want to get in $11 stocks with 69 relative strengths. So that's the problem. And it's an early turn. All right. It's not in a confirmed uptrend. And if you get it right and it happens to be, you grab it early here, maybe it works out. But yeah, that just doesn't make the cut.
Govin's asking, NVAX was a buy alert stock last week. He got lucky by buying it. That's up 100%. Let me just pull that up real quick because that did blast out on some drug result or trial results, and actually up more again today.
That one I really liked, and if the market was better, I might have been buying that the day before as it popped its little head out there and then had a little squat. And I might have got lucky on that one with that gap the next day. But that one, now that's a nice setup. That really is a really nice setup. And like I said, if it wasn't for the market and me scaling back things, I probably would be in that.
This is looking at it 2 days ago where Mark's talking about it just broke out, and this is where he would have considered.
Yeah.
The question Govid's asking is,
nice big base.
So he did sell 60% of it. How would you handle the rest at this point?
No, but just the same thing. I would just backstop it if you either sell it and be happy with your profit or backstop it and you give it some room. And if you want to play it for a bigger move, I mean, if you want to truly free roll it, you can certainly sell a percentage and move your stop to break even, and then you don't lose any money on on the remaining shares, and you give it tons of room. But once it's up this much, I would never let a stock come back to break even. So I would just backstop it at this point. That's a personal decision too. I can't tell you if the stock's going to pull back 10% or 40%. I don't know. I just have to come up with a number that I'm happy with, and that's based on my own what my own goals, and also my risk reward relationship. What did I risk and how much profit do I have? If this would be a huge multiple of your risk, obviously.
Dan's asking, Mark Ritchie, he understands your average loss is around 3%. Do you set stops around 3%, or do you just sell immediately if your stock does not go up right away?
Well, neither. And yeah, just to dispel, like when I was saying, stops were running around 3%, that was, during a really good period last year, but long term, because I'm running bunches, guys, over periods of time. So I may run, my last 30 trades, my last 60 trades or something like that. But longer term, it's more like 4.5. But and these are averages. So yeah, I might sell one for a 7% loss and one for a 1% loss. So those average 3.5. So occasionally I will just sell if it doesn't just go. And Mark's talked about that as well. But that's not normal. Normally I pick the stops. Sometimes I stagger them as well. But it's the same thing that's being taught here.
Yeah, Tim, on a follow-up to that is just asking the average gain loss or win-loss ratio for MPA for the last 3 years, as that has been consistent actually for now our 12th year in business. The numbers are unbelievably consistent year after year. And just to use round numbers, we're averaging roughly 10% on the winners, 5% on the losers, actually a little bit less on the losses actually, but and that works out to a win-loss ratio of at least 2 to 1, which is what Mark talks about in the book, that he's seeking a minimum objective of $2 a profit for every $1 that we lost. And we have that. If you go back and look at every trade, 2,000 plus trades in our service, it's exactly.
And generally what happens is, even when the market gets tough and we're having a tough time, we generally maintain that 2 to 1. I might, tighten up the stops to make up for the smaller gains. And what usually happens though, where, it goes bad, is that the batting average comes down. We just have less profitable trades. And that's how you're just not in a very good market. And, during that period, you got to trade small or just, sit out.
Yep. Jeff is asking if Mark can briefly summarize his offensive sell rules. I sell winners chronically early, and I just would like to hear Mark go over some bullet points on how he holds winners and when he starts selling. Do the rules change at all based on market conditions?
Well, I'm the worst guy to ask that because I sell chronically early all the time too. So, I think you go to my book, Think and Trade Like a Champion. There's a whole section on selling, and that really spells out the sell rules really well. I tend to, just like to hear the cash register ring, and I'm happy with a profit of, if it's up 20% and I made X amount of dollars. I don't care what it does after that. I just sell it. I made 4 times my risk. I sell it out. So I'm not really like trying to. Back in the day, I really tried to get everything perfect and stick to all the sell rules and get the most I could out of a stock. I realize it doesn't really matter. If I miss 100 stocks that go higher, I trade another 100 trades, and it all comes out in the wash. I just trade more and I compound it with smaller gains. I can get there either way. I can get there by big gains and less trading, or smaller gains with more trading. And I just found I have more control by selling into the strength and just rolling it over. So, but all the sell rules that I use are in my book. They're
And I talked to Jeff actually this past week, so I'll share with everybody what I shared with him. He had a hard time holding through natural reactions because he has that profit, doesn't want to see it go away, and even though sometimes they go higher, sometimes they go all the way back down to break even or stop you out. So I shared with Jeff just to use to practice holding this small enough amount of shares that it wouldn't matter to you with if it does go all the way back and stops you out. If you had 1,000 shares, just hold 100 of them. Just something that he can get used to it with a very small amount
right.
that doesn't get him panicky.
But that also might, no, that's giving you some information about what your personality is and what type of trading you may need to engage in. So if you're that type of person, then you're more geared for shorter term trading. And that's what you should do. Now, of course, if you can't sit through a natural reaction and the stock's up 4%, well, then you have a different problem. Now so, but if you're talking about, you're on your second natural reaction, the stock's up 20% and you risked 5, it's okay to be selling there. It's not there. That's fine. Again, the math is working. As long as the math is working, it doesn't matter what happens after the trade. It matters what happens. Risk and reward is managed within the trade from the time from where you buy it to where you sell it. That's the continuum of.
Attention, an alert target has been reached.
Let's see. I don't know what that was. Let's see. It might be an old alert here. I don't know why that's coming up, but it's ETON. ETON. It's one that it's a $9 stock. It's in a big base, 72 relative strength. So here's another one that's sort of like that, that previous question that we had. Here's a base, $8 stock, 72 relative strength, no earnings. It's really just not a high quality name that I want to buy. If you take a look at the 10 rules for reducing risk that we just put out, in there, it says to upgrade in quality, right? Not downgrade and go down to $9 stocks. So this is where, when the market gets tough, you want to upgrade in your quality. Quality is in terms of price per share, in terms of the bigger companies, maybe higher volume traders, higher quality grading, the chart pattern being a more solid chart patterns and so forth.
Question being asked about your opinion, Mark, from Nelson here, the risk that's being highlighted with the depository or the clearing companies with all the volatility in the trading these days.
Well, I mean, I don't know. I don't know what clearing company, and if it's a reputable brokerage firm, you should be fine. And again, you have insurance up to a certain amount. And so,
Any risk in the market? I know Mark Ritchie and I were talking before we started here that there's, what was it, $30 billion of GME option trading, Mark Ritchie?
I think the question was, is there potential systemic risk? I would say anytime you have highly leveraged players and somebody blows up, And there's been some, talk of hedge fund blow ups. You may see more selling, forced selling. That could
Yeah,
happen.
of course. There's systemic risk. There's always systemic risk. I mean, but I wouldn't get too concerned about that. I mean, look, again, you're trying to have that top-down thinking and try to come up with the big picture. That's not the way to approach stock trading. Approach it stock by stock. You'll be stopped out of the stocks.
Yeah, I would add to that too. I've been in this room for over a decade now, and it's like I've seen Mark go to cash how many times, or even short the market, and then coronavirus, shows up, and then we had that Volmageddon thing in 2018, and it's like then you hear all this stuff way after. If you just know how to read the stocks, you're gone. You're long gone before the hurricane hits the beach.
Yeah, if you were to look at my trading over the last 30 years, you'd think I have a crystal ball, and I don't. In my office in New York City, when people used to come in and the new guys would come in, the seasoned guys there would come up and say the saying was, Minervini's got Monday's paper on Friday, because I would be in these stocks, and then all of a sudden news comes out, or the market rolls over after I sell everything, or I go bullish, like in '98, the Barron's article, I went bullish, and then we go into this big bull market. There's no big tea leaves or any crystal ball or any real clairvoyance. It's just there's a lot of stocks meeting the criteria. When you see right now, if you see a bunch of stocks breaking down and having pivot failures, okay, well that says that you're probably going to have some pullback in the market. Now, if you get a whole bunch of base failures, that is much more ominous. And so right there, if I see a whole bunch of stocks breaking down and they're just blowing through the bottom of the bases, that that's like a broken leg. A pivot failure, you could say, is maybe a sprained ankle, right? So how long does it take to repair a sprain? Less than a broken compound fracture. So again, just looking at how the stocks are acting, if you get good at ascertaining the individual stocks and you run your screens and you look, or you're using my buy list, you're going to be well ahead of any indicator, any guru, anything that looks top down. You're going to be ahead of it 99% of the time. You're going to be in stocks when you should be, out stocks when you shouldn't be. You're going to be in every bull market and out of every bear market way before they take hold.
I have to say, this is as golden of a golden nugget that you guys could be getting, because that is as simple as it is for Mark to be in the market at the right time and out of the market at the wrong times. And it is that crystal ball effect of just knowing how to read
And
stocks.
Bob has seen it for 15 years. Bob's been
Yeah.
with me for 15 years. He's
Yeah, and I can just add a little color to that too. I remember going to the Master Trader program. It was brand new with this or whatever, and that was my question. You're telling me just follow stocks and that'll keep you out of a 2008 or whatever. And I happened to be sitting next to Matt Glasscoff, and he's like, "Just trust me, just follow the stocks." Like I've been doing it. He was doing it since the '90s, whatever. He's saying it's no different every time.
So Matt Glasscoff, if you don't know, Mark has mentioned his name a few times. Most of you don't know who he is. He's a pretty private guy.
I'm gonna get in trouble for mentioning his name.
I know
probably.
he hates mentioning his name, especially his last name, but nobody knows him. But he's a really great trader. He's he's a sort of a disciple of my trading style, and been to master trader programs. He was one of my very early clients. He was a money manager. And that firm was one of my institutional clients, and he was the money manager. And I sort of groomed him from when he was a very young guy. And he's just a really good trader that we respect quite a bit.
Yep. Piawadi is asking, when you short the indices, would you consider moving the stops when in the money, since we are still in a long-term uptrend? If so, how would you move your stops?
Well, I don't know what are you talking about? What stops on what?
When you're shorting the indices.
Yeah.
So DIA.
Well, I've given you my stop, my plan. My plan is if it goes to new highs, and now if it gets at a profit, I'm going to just take the profit. There's not enough room to start like backstopping and moving your stops. There's really not a whole lot of room there. What's our stop? 1.5%, 2%? Mm-hmm. How much tighter do you want to get? And what's our gain right now? 2%. So if this market comes in and we get a decent correction, what are we going to be up on the short? 6%, 8%? So I'm just going to cover it. This isn't where you're going to make your money. This is more of when I short the market, it's more of a statement than anything, to be honest with you. I mean, every now and then I do put on a very large, like I'll put on large short positions with the diamonds because the stop is so tight and it's so liquid. I mean, there's been times where I put, huge multi-million dollar, positions on with a very, very tight stop, and I hit pay dirt. One was before 9/11. I was short going into 9/11. It was a very mixed emotions, let me tell you, when I found out what happened and knew that I was going to make a fortune when the market opened, but at the cost. I would have gladly given the profit back and not to have that not happen. We had clients in the World Trade Center that actually perished. So in my office, wasn't far away. So my assistant was in the building 10 minutes before the towers fell, and he was so freaked out that a year later he quit, and he wouldn't even ride the train anymore. He was scared to be in New York. It was just a disaster. So, but again, that was a huge short position that I took. And but that's not where, if you go back, I was on IBD Live today, and I made this statement. We were talking about shorting. If you went back and you looked at all my trading for 37 years, and you looked at all the wealth that I've created, you know what percentage of it is from shorting? Not even 1%. I don't even know if it's 0.1%, but it's certainly not even 1%. So to me, it's unnecessary to even worry about it. The money is made on the long side. As GME shows you, there's unlimited upside, but a stock can only go down 100%, and very few stocks go down 100%. If you short a stock and it goes down 20 or 30%, that's a home run.
Yeah, and these blow-ups are happening from people who shorted GME without stops, period.
That's right. That's right. Pros. If you think pros are using stops and they're prudent, you've got a lot to learn about professional money management.
And proof of that is you're looking at, what might be a 5 or 10% gain and 100%, 200%, 300% loss in the risk reward dynamic that they're putting themselves into.
That's right. What you're seeing is pure arrogance on display. That is the arrogance of Ivy League, MBAs that think they know, more than they do, and more than the markets, and double up, and it has to go down. It has to go down. This is crazy valuation. And meanwhile, they go out of business. Long-term capital had Nobel Prize winning PhDs, the smartest people on earth were running that fund, and they blew that fund up into zero.
And you just had Steve Cohen's guys. He lost 50% in January, 50% in 1 month.
That's right. And there was a couple other guys that were down 30% just recently that were big.
Enormous.
Yeah. And that's so again, that is your big advantage when you're relatively small. When I say relatively small, I'm talking about if you've got a $20 million portfolio, you're microscopic. But for an individual, that's serious money. But relatively small, especially if you're managing 100,000, 500,000, $1 million, you can maneuver and cut your losses and get in stocks and in and out in the drop of a hat. I mean, just instantaneous liquidity. And that is the big advantage. You got to take advantage of that. You got to maximize that and take advantage of that. That's your advantage over the big guys. That's why GME is running up. They don't have that liquidity.
Tony's asking Mark Ritchie, how long were you trading before you were able to really understand progressive exposure and use it right?
Well, I wouldn't say it was a time in terms of understanding it. I think I understood it right away, but you got to go through a couple of cycles, and every now and again, especially when you're starting in trading, you kind of have an aha moment or two. But I would say before I really got comfortable, it's probably a couple of years even, because sometimes you're in a good market, everything's going up, and progressive exposure isn't as important. But I would say a couple of years.
Yeah, there's one thing of intellectually understanding something, which comes fairly quickly if you're somewhat intelligent. And then there's applying it and understanding how it actually should be applied and how to maneuver with it, and to start learning the drawbacks of it and the strengths of it, and how to maximize the strengths and minimize the drawbacks. That takes time and experience. And as far as aha moments are concerned, again, I'm 37 years later and I have aha moments all the time. So those aren't going to stop. We're always learning.
That's a great point. Yeah.
Yeah.
Rod is asking if you have a watch list of, say, 20 stocks with similar criteria and you choose 5 and you buy them in terms of progressive exposure, do you have to base your scale up, scale down decisions on your actual results of the 5 longs that you picked? And similar question in the concept of what progressive exposure is. I'll shortly say there is a full video that Mark has recorded on progressive exposure in the video archive tab. It would be helpful to watch through that. But Mark,
Yeah, it's pretty old, and I think I'm not sure how good of a job I do at explaining progressive exposure there. I haven't seen that video. I don't know if I ever watched it in the first place after I did it, but again, and Mark, you should really touch on this too, because you're really good at, maneuvering and massaging and jockeying, if you will, for position. It really depends. And I know Mark will give an answer that's similar, but if I've got 5 stocks and all 5 of them are up, say, 8, 10% right out of the gate, everything's breaking out and working out perfectly. Okay, that's enough for me. That's enough for me to get more aggressive. So I've got to measure that. I've got to try to decide. And that's really, going to be somewhat of an art form. I don't have clear cut black and white rules for that. Now you could say, well, those aren't nailed down profits. That's true. Those are open. So you've got to be cognizant of that. Maybe, for you to nail down profits, it might take a little while. It might be too late. By the time you are nailing down profits, most of the good, the leading stocks took off already. You have to look at your watch list. I mean, is there a big watch list and you've got a lot of stocks breaking out, or maybe there's only a couple names and they're not working that great. You've got a few that are up, a few that are down. Well, then, I'm going to probably hold off and I'm not going to pyramid up. Mark, I mean, I know it's going to be similar to what I said.
Yeah, I think one of the things with the progressive thing is people want a scientific answer.
Yes.
And there's a little bit of intuitive, not a little bit, there's a lot of intuitive feel in that. And that can only be gotten through experience. So I think your point about knowing something intellectually versus, sort of that aha, oh, I get it now. I've seen this, I've experienced it and executed it properly. Well, I can tell you this, if it takes you 5 years, it's worth the 5 years. That's kind of the point I would make. But, so yeah, to your point, let's say some of it's very dependent on how many stocks you got. Maybe you only have a couple names, you buy 2 and they both blast off, but there's not many other setups. Well, you got to wait, That's kind of what happened. I think in April, we didn't really have a lot of setups. We had a follow through day in the market and they were kind of short. There wasn't a lot of ideas right away, but they all worked. So I was like, well, whatever the next idea I'm going to buy, you know what I mean? And that was kind of how I did it that time. Where other times it unfolds just a little bit different, but the principles are the same. Only add to success.
Yeah. The only really hard, fast rules I would say is, I wouldn't go more than probably 50% invested on your first leg in. 25% to 50%, and that could be one stock at 25%, 2 stocks at 25 to equal 50, or 5 stocks at 5% each. And again, you've got to make that decision for yourself with the kind of risk tolerance that that you can handle. Again, but you want to progressively get concentrated. When things are working, you want to try to get concentrated and to really, start putting on some size. That's the whole idea. But, again, if you were to, can a computer, race a car? Like, a computer is going to be able to drive a car. We're going to have autonomous, cars, but how about if you could you put a computer on an Indy track and have it negotiate turns and stay 2 inches from another car's bumper? No, you've got to have, that's where the human brain, eye, hand coordination is amazing. There's nothing like that computer, to make those instant impulses that are fractions of a second that the brain can, weigh all these different things. It's the same thing with stock trading. If you think of it as driving flying an F-16 or driving a race car, that's what you're doing. You're gauging, what's you're feeling on the road and seeing and hearing and making those changes. That's the beauty of this. There's an art form to it. And again, I'm going to point this out. I say this all the time, but you have to thank your lucky stars that there isn't a black and white answer. If I could give you a black and white answer and say, you do this when it does this, and you do this when this does this, and X equals Y, there would be no opportunity because it would be fully quantified. You could put it into a spreadsheet, into a computer, and every inefficiency would be, the market would be truly random. The reason why it's not random is because stocks aren't perfectly priced. That's the beauty of it. And thank God it's been that way through my whole career, and I don't think it's going to change anytime soon, or if ever.
Follow-up question from Norm asking just about your opinion. We kind of already addressed this, but just the idea of, is there a website other than Reddit to find the most up-to-date list of short interests? And I would warn you, that's not a trading strategy, as Mark has already mentioned, that you're going to have a lot of opportunities to repeatedly get on names that are being driven up by a crowd sharing website of short squeezes.
Yeah. No, I'm not even going to go there because that's, yeah.
Dean is asking when Mark covered his buy list this week. He mentioned several power plays that had RSs in the low 90s. I missed these on my own screening because they were lower RS rankings. I'm assuming that the RS is expected to rise before breaking out of the pattern due to the market breakdown, and hopefully those stocks will be holding up.
Well, yeah, I mean, like I said, it's not really a power play if the relative strength is 89, but could it be if we're talking semantics here, like CURI, that's a 90 relative strength, but it did double and it's got a little base here. I have seen more than ever. I've seen, I should say this, I rarely ever saw power play type situations work and break out like they have been lately that didn't have the really high 99, 98, sometimes 97 relative strength. It seems like we are getting some of these short bases, these power play bases, that some of them are working from a lower RS. So again, if it's working, maybe you can play that. Maybe that's sort of a theme that that's taken hold recently. But I think that's another sign of a lot of froth in the market, that they're running everything up. And I think it's a lot of retail buying that's doing that.
Brian's asking, how do you guys interpret long upper wicks? For example, a recent action on U, big reversal, pull up U.
Yeah. So I don't call it a wick, but I guess a wick is a candlestick term?
Topping tail, just a reversal.
Yeah. So, well, I guess a good example of that would be the stock that moved out today. That was STTK, which is now negative. It went up, I don't know, 18 or 20% breaking out today. Nice, quick. And this is what I was saying, that you can short-term trade a lot of these. They're up big on the breakout. You can either, sell a portion of it or just take the profit and be happy. And now this thing's all the way back down. So that's a gigantic, what I call a squat. This is a full-scale reversal and a squat. That's a lot to recover.
That's a power squat or something. I don't know what to
power
squat. That's a large squat.
I got to come up with a new name for
That's right.
Yeah. So, but basically, it's not a sell signal with this. Such a big and so much ground to cover. This is one that, I probably would be out of, at the break even point. Once it was up like 20% on the day, I would have already moved my stop up at this point and sold some.
If Steven's asking if a stock has a pivot point at, for example, at +5, +7% from yesterday's price, and during the day the price runs up and reaches the pivot, would you still buy it after having a 5 to 7% move?
I have no idea what that means. You got to show me a stock and a chart. And talking in these hypotheticals, that's to me, that's like a riddle you just gave me. I don't even know how to answer that. I don't even know what that means, to be honest with you. I don't know.
So
Mark, can you understand what that means?
Yeah, not exactly.
I don't understand.
He's saying if you're in a base and the pivot point is 5%, 7% above where the price closed the day before, so the stock would already be up now 5 or 7%.
Okay.
Now breaking out.
Okay, so you're saying that, so the distance from where the price is now, for
Right.
it to get above the pivot and break out, it would
That's
have
right.
to be already up 5% before you bought it.
Would you still buy it is the question.
Well, yeah, sometimes, but I gotta say, once it starts getting into, above 4 or 5%, yeah, it really, it starts to be, short-term extended on the day basis. And again, it's up. This is something that Mark Ritchie and I have talked about several times where, I sometimes he'll look at a stock, it'll start moving and I'll tell him, I don't know, man, that thing's already up 6%, and it doesn't mean it can't go up more and end up being up 20% for the day, but not that many stocks move up that much. So I would prefer it to be up the least amount possible when I'm buying it. I want to be selling when it's up, not buying. So it's a good observation. The answer is that, you have to make a determination, as far as how much you want to own that name and, how far your stop is away from that too. So, but generally speaking, I might stay away from it at that point. Yeah.
Tom Payne asking thoughts on XP. Is this a low cheat? As an example of a low cheat.
XP as an X-ray Paula.
Right. I have it up on the screen. It's not.
It's a cheat area, but it's a 55 relative strength. So again, it's a very low relative strength. Is this a recent new issue? Let me see. Yeah. So being a recent IPO, but does have quite a bit of, yeah, I mean, it's a cheat area. You definitely have a cheat pivot there and it's moving above it today.
Not a low cheat though, Tom. Low cheat would be the bottom third in this area.
Yeah, the low cheat would have been that pivot before that. We might make a case for a low cheat, but this is in the middle third.
Yeah. And then this is the top third and the middle third is the cheat area.
Mm-hmm.
All right. Robert is asking if you can tell us how to analyze short interest on MarketSmith. I don't even know where that is.
Yeah, you just click on the weekly. Click on weekly. It's up in the left-hand corner. It'll say how many days and the percentage.
So help me out, Mark, because right here.
Right there.
Click on the weekly and then up in the left-hand corner.
I don't even look at this myself, and I'm a short guy.
I'll say how many days how many days of average volume? 1.9, whatever we'll say on XP, it's 1.9 days of average volume for it to cover the short interest.
All right. Valentino, yeah, that's right. Tyler is asking, what specifically does Mark like about HLF to be considered a special situation?
Yeah, I like the price and volume action. Just looking at the price and volume, if this was a higher relative strength stock, I really would be super interested in it. Just if you look at the accumulation on the up days, and there's very very little selling anywhere in there. If you look at even the weekly, there's a lot of buying. It's got a very tight base, pretty good sized base. It just has, as David Ryan would say, it has the look. It's a good sized base here. It's tightening up on the right side, but it lacks the relative strength, and that's really a big thing because, quite frankly, this is a name that I won't even look at. Sometimes I have people will shoot me a name, or I don't know, hear about it on TV, whatever, and I'll just pull up the chart and I'll see a low relative strength name. But the majority of my screens, almost all my screens, are cut off, much higher than this number. I guess maybe I want to take the challenge here, see if I can find a 54 relative strength that works. But if I were to buy a 54 relative strength, this one meets the criteria. Good earnings too. It's got nice earnings too.
We have one who's sharing that he did buy IDT crossing the high of 2 days ago at 1430. The high of 2 days ago.
Which one?
IDT.
Oh, IDT, yeah.
Oh, yeah. He bought it this morning. Okay, I got you. He bought it right here, taking out the high from 2 days ago, 1430. Would you consider this a pullback buy? Why wasn't this added as an official buy on the platform?
Well, because I'm being conservative right now. It's a $14 stock. It's a lower quality name, and I'm short the market, and I'm thinking that we're going to correct here. So I'm just being more conservative. If you want to take these, fine. Yeah, I mean, it's just a little, whatever you want to call it, a handle or a pullback to the breakout point. A little natural reaction after it It broke out on the 22nd and then pulled in for several days while the market has pulled down. So it's actually, it's actually acting really well during this market pullback. That's why it's on buy alert.
Yep. James asking, is volume at the breakout point a useful indicator that a breakout might work? How would one monitor this?
Well, you want to see, you'd like to see volume, yeah. But even more importantly, I want to know what's happening in the subsequent days. If can I follow through? Can I hold up? Can I pull back orderly? So it's not just on the breakout day, but you'd like to see volume come in. But if I don't get the volume, I'm still okay with that. It doesn't mean I'm not going to buy it if in the morning, stock's breaking out and there's not big volume. But it is, of course, you want to see bigger volume on up days and lower volume on down days. That's the contrast that you want to see.
Yeah. Daryl's asking if we're long MFCE. You thought there was a sell last week. We sold MCFT, not MCFE. Just pay attention to the open positions tab on the platform. That will always show you what we have. And MCFE is still currently a holding. Atul is asking, can you explain the following models, the trend following model versus the long-term trend model? Is there a difference of the two and the risk model?
What am I explaining? I'm sorry.
The difference between the trend following model and the long-term trend model. Is there a difference between those two?
I don't understand the difference. What is the long-term trend model versus
those are basically, they're on the graphic that Mark shows. I think it shows trend following model, but we on the platform refer to it in our notes and comments, long-term trend model. They're one and the same, just two different titles that we use. And the long-term nature of that versus the risk model being more intermediate term for
the risk model has completely different parameters. So it's a completely different makeup than the long-term trend model. And the long-term trend model has some very complex. There's a few simple indicators in it, but there's some very complex ones too. And again, really, please just trust me and ignore these indicators as far as for stock trading. Please don't get too hung up on these models because they're gonna. It's just, I assure you that it's more important to focus on the stocks, and the stocks will keep you on the right side of the market way better than even the models.
There are some ticker symbols being thrown in here. I will remind everybody, you do have that feature on the platform. The symbol Dropbox is how you can type ticker symbols in that do get reviewed. They go to Mark's computer directly. And so that would be where to send these different ticker symbols. I see people typing in here.
Some of you are old enough to remember when you had like the oil light in your car. I mean, you still have an oil light, I guess, but back in the day, we called them the idiot lights. When the oil light went on in your car, it was like you were like 8 seconds away from it blowing up. It was like the final straw. You didn't want to see the oil light come on. Let's just put it that way. That's sort of how you got to view, these models, as these are sort of like, these are the idiot lights. These are the ones that, okay, you didn't pick it up in the stocks, but now sometimes they lead every now and then, not usually the long-term model, but the risk model is really good at coming off the highs. And sometimes it goes on a sell and then we start getting stopped out of stocks. But again, they're really sort of the, I refer to them as the idiot lights.
I'm asking on TDOC, would this be considered a pullback buy if it closes today in the upper half of the trading range setup?
Well, it's a pullback buy, but it depends on where it occurs. So this is occurring extended. So pullback buys, my definition, in order to trade them, have to be within the base or just sitting on top, pulling back to the breakout. This is extended. So this is not a pullback buy. For my definition, yes, it's pulling back. And if it turned up, you can use that type of strategy. This is a natural reaction. So you would be buying the pullback buy from a natural reaction, buying it extended. But TDOC is acting really well. I have to say, it's really acting strong here. And it looks like it wants even higher.
This would have been an opportunity right here as a pullback buy, better than this.
Yeah, I have to run. I don't know if you're going to continue. I can maybe come back in a minute, but you guys take over. I'll be right back. All right.
Okay. Mark, let's try to rapid fire through a few more questions before we wrap up here in our time. Martin is asking, he also recently bought NVAX at 133, got a big pop and sold off all of it at 194. All right, Mark already went through how he would have played that trade. Anish is asking, hey guys, when some of the small caps start to break out, the price is jumping so fast, and by the time he sends his buy order, the price goes way extended. What broker are you using? Or are you using direct market access to get your fills? Do you use a TradeStation, Mark?
Yeah, I use a couple different, but TradeStation and IB are the main two.
Yeah, I use those too as well. As Ameritrade, Mark uses a few different ones. It's really not going to matter if you're putting orders in as limits. You definitely won't have any kind of problem with that, but you definitely do want to make sure with some of the more retail-oriented sites, the Fidelities and Schwabs, if you will, they're not going to be showing you, just the fact that you're putting in a ticket order through a website as opposed to a platform direct access type of setup or platform tends to be a little bit more on top of things. But if you're using a buy stop limit rather, you should be just fine. Parabolic stocks, where's the support only has momentum. Oh, okay. This was some of the names that Rob was typing in before. Anish asking also, Costco employees are talking about GME with sharing that he said with him, it's a scary world out there. Trying to get past some of the stock questions that are being typed in here. George is asking, are you guys concerned that the rise of inflation, hyperinflation of the dollar due to money printing? Any comments you want to share about?
No, is the short answer. I'll say, even the macro stuff, guys, we don't really focus on that here. I think a lot of that is overblown, at least in the short run. I mean, it's like how much of the world's denominated goods are still traded in dollars. The idea of a hyperinflation happening just does not seem very likely right now.
Any concerns of macro events like that are going to be felt in the stocks way before
Yeah,
that.
that's absolutely right. You'll see you'll see it in the stocks. So
Yeah. There's been talk about that for the last $20 trillion of debt that the U.S. has put on,
and my whole lifetime for that matter too, guys.
If you've been out of the market for the last 10 years worrying about the deficits, you look what you missed out on. Does or another ticker symbol, you guys got to use the symbol Dropbox. Scrolling down here. Can you please review how to calculate expected price movement by using options? Okay, there is a video tutorial that I have done on calculating the move during an earnings event from the options. So Jack, go ahead and look on the video archives tab and scroll down till you see that header for calculating, estimating a price move during an earnings event. All right, just real quick, Mike, asking about the terms and conditions that was emailed. Every one of you has been sent an email from zohosign.com. It is legit, it is real that we are just updating our files for 2021. They are the exact same terms and conditions that was on the sign up page from the website. So there's nothing different about it, no changes on it. It's just purely that it's the new year. So we send out to everybody for updating our files for everybody having that signed off on. So it is real and virtually everybody has signed it. So if you still are lingering, please do get that signed right away because you do have a reminder that gets sent to you every day to annoy you enough to the point that you do sign it. Mark did comment about DKNG on the study session. So I would share just to review his comments from the study session earlier this morning on DKNG. Mike, Rick, sorry. Who do you have for the Super Bowl? Well, I guess can answer that quickly as we're wrapping up here. I am hard to pass by a team that looks like could be the team for the next decade with Kansas City.
KC?
But yeah, KC, they look
I bet KC in the playoffs and I won, and I think I'm going to bet the Bucks.
I don't gamble, but I'm rooting for the Bucks.
Yeah, I've had enough of Tom Brady, so he's had.
I think Brady's gonna.
He's got one more in him, man. He's got one more.
As impressive as he's done for 10 Super Bowls, rather, almost half his career in the Super Bowl, which is amazing. I think he's had plenty to enjoy. Let's move on.
Yeah, they have their home stadium. It just seems like everything's lined up. But and the whole world, loves KC now. But I KC is amazing. I think this is going to be
It's
one
gonna
of
be
the
a
best Super
great Super Bowl. Yeah.
Yeah, it should be one of the best Super Bowls ever.
Yeah, it should definitely be
On
very
paper, on paper, it should be one of the best ever.
certainly an offensive feast, that's for sure. But let me just see with Mark back. I think we just had one or two last questions, and then we'll wrap it up for the day. Actually, we got through virtually everyone.
Oh,
Pretty impressed with that. The one question from Mark. Just talking about gap ups on that AVNW that you showed earlier, that we talked about earlier, Mark. How much of a gap would be not too big of a gap for you to be looking to trade the name still?
yeah. Let me see. I just want to look at it on my other screen here. Hold on. Let me see. So it seems like on my chart, I don't see a gap, or at least as big of a gap. It looks like it opened right at, let's see here, 36.55. Looks like it was actually, just a very small gap. But on the Market Smith, it looks like a larger gap. But to answer your question, the same thing, I don't want it to be up more than 1 or 2% past the pivot point, and the gap itself, 1% gaps, small gaps are fine. I prefer no gap at all, but I don't want to chase big gaps. Playing gaps is a whole nother strategy, and some people I find there's very few people that are good at it, and even the ones that are, it seems like a real scalping strategy to me because a lot of the juice is already out of the lemon, and I want to be selling into gaps when the stock's extended and breakaway gaps. I just don't like I haven't done well with it. I tried it in the past and I never could do well with it. So I stopped doing it.
Yeah, this was a 2% gap this morning from the close yesterday. And if this was, if Mark was in more of a buying mood with the market, this would not be too excessive for him to be.
Yeah, I might have bought that because even with the gap and you buy it coming through, use that low of 34.20. I don't know. What are you talking? 5-6%? That's a it's a pretty tight stop. And coming off the lows there, you're getting in off the pullback buy. That's a nice little entry.
Yeah, and that actually is. Let's just see one last question down here. Yep, you're welcome. You're welcome. Just the ZI last stock that you threw up on buy alert.
Yeah,
Just
see
asking
that's
to.
up now. Yeah, that came out here, and I mean that's viable. It's viable. Again, if the market was, if I was feeling a little bit more confident with the market, I'd probably be buying this here. But it's definitely viable. You're just going to have a lower success rate right now if the market's in correction. I just want to point out something real quick to those of you, because a lot of people, on our service, and a lot of newbies, and if you're having trouble, it takes time. This takes time. Don't be hard on yourself if you're not doing great in 3 months or 6 months or even in a year. This takes a long time, but it's worth the investment, because once you get the knowledge and the experience, this can pay you for life. The stock market has changed my life, totally changed my life. And I was very poor, had a few $1,000s to my name. I've been able to move to the top 0.1% of income earners and net worth in the world from the stock market, with an 8th grade education. So if I can do that, just think what you can do with me helping you and guiding you and the type of information that you have nowadays. I mean, it's 1,000 times easier. It's 1,000 times better. It's 1,000 times faster. Your learning curve, I mean, everything is so much better. It's a great, great time to be a stock trader. But again, with all the information and all what everybody has at their disposal, they think that they should be a pro in 2 months. And it's just not going to happen. I don't care if you've got the best, if we form a team of the best market wizards in the whole world and the greatest traders on earth, and you can pick all our brains and know everything that we know, knowledge wise, you still have to have experience. And there's no way to force that. You cannot force the experience. You have to earn that. And that takes years, not months. So just keep that in mind when you're having trouble and things aren't working and you want to say this strategy sucks, the market sucks. No, you just aren't where you need to be yet. and just keep working at it and you will get there. And when you get there, trust me, you will say, thank God I listened and I stuck with it, because it's all been worth it. Just like when Bob pounds you into going to the Master Trader program, and 100% of the time, every single person who's ever come to the Master Trader program, thousands of people, every single person says, thank you for pushing me into that. This is a great decision. It was the best thing I ever did. Because we know it's the greatest show on earth. We got to get you there and you get the knowledge. But again, you got to put in the time, and you got to get the knowledge. I say, get the knowledge, first you get the knowledge, then you get the experience, then you get the skill, then you get the money. My sort of Scarface for the stock market.
I know there are people who are listening who know what Mark's talking about when I am bending your arm backwards to get you to do something is paid off, because I talk to a lot of you again and you tell me. So he's exactly right. Trust the process. That's all I can tell you. Trust the process. It has led to fortunes, and we're talking about millions and tens of millions of dollars created of wealth that Mark's members, students, and proteges have all been able to do. Last question here on DraftKings, just asking about the range of the last few days of it being wider is accurate, Jeff. You definitely would want to have this pivot tighten. Even better, something that I'm drawing in here as a visual to have a concept that would be ideal for us to see. And if we get it, you can be assured.
Yeah.
Watch it.
Well, let me say here, if this breaks out here, yeah, I guess I would like to see it tighten up, but it may come out. I mean, it's holding up quite nicely with the market coming in here. And if this breaks out, you got to make a decision whether you want to pay up for it. Now, you can just use a percentage stop. I might buy this.
Right.
If this comes out here and gets above that high, that 57.89, I might, bite the bullet and buy this, because it's a big, nice base. And there's a lot of things going on really good for DraftKings right now. It's holding up great in a correction. So sometimes, you have to buy. This isn't, crazy loose price action. You got to put it into perspective. First of all, in the base, it is tight on the right side. You do have a VCP, and you got to put into perspective that the market is pulling back and it's holding up, pretty nicely there.
Yeah, and that's the other thing I was going to say. The perspective of the whole activity, this is actually very tightening, even though it is still representing 8%. But especially in a market downdraft, this stock is holding like a champ.
I would look at the relative strength line too. If the relative strength line is breaking into new high ground,
right,
or hitting new highs, which it's very close to right now, that'll mean that the stock's holding up against the market. So if the market comes in here and maybe comes off another 4 or 5%, and this stock stays tight, that relative strength line is going to move into new highs. And that's going to tell you that, this stock wants to go higher.
Yep. Last questions here. I see asking about the Master Trader program. Those tentative dates in November, it is an online event for sure this year, even though the dates may get tightened up a little bit, but it is definitely 100% going to be online. So that's something I can tell you for this year.
Yeah.
We'll have more details about that in the next coming weeks. So with that said, we appreciate you guys joining us today. The replay will be available in a few moments, and we'll get back at it. Pay attention and stay tuned to the live stream for updates from Mark throughout the week. And we'll look forward to hopefully a great Super Bowl this coming weekend.
Yep.
Thanks, Mark. Thanks, Mark. We'll talk
Take
to you
care,
guys.
guys.